Hey everybody, welcome back to AWM Insights. It's your hosts, Brandon and Justin. And as you know, each week we cut through the noise that Wall Street is trying to sell you to bring you the knowledge, skills, and access that you need to invest like a pro. And today we're going to tackle the interesting topic of your investing superpower. That's the lead in. We'll let you know what that actually means in a bit. But before we get there, Justin, what's going on in the news?
Well, big news over the usually quiet Thanksgiving holiday, even Friday to be more specific, the day after Thanksgiving, which is typically quiet. The markets were pretty rattled from the news of I keep wanting to say Omicron, but it's Omicron, I believe. Omicron variant, the variant of concern, new COVID variant out there coming out of South Africa. And, we talked about this internally actually before we recorded that markets hate uncertainty. And this is a big kind of pill of uncertainty, if you will. Markets are the disruption that we saw on Friday has calmed as of this recording. So hopefully that will continue and we'll get as I call it, the Santa Claus rally into the end of the year here. But, your guess is as good as mine on that one. Then not something that's immediately relevant necessarily is going back to the IPO topic, which we've touched on plenty throughout the year. And looking at what's happened so far this year in the IPO market, we always see the headlines, Robinhood was rocketed, or Rivian, that's the most recent example, great example where, I think it almost doubled in price or did double in price a couple of days after the IPO. But half of all companies that raised more than $1 billion in IPOs so far this year are trading below their listing price. And that's not unexpected. Again, and we're going to kind of talk about this. I think this is somewhat relevant to the topic at hand today, but the data generally shows IPOs aren't great investments, but the headlines really lead us to believe differently just because of that they'll highlight, the one or two that actually succeed incredibly well. Or they'll just highlight it on the day it actually does succeed and not follow up a month or two down the road and say, oh, actually this one's down. So not unexpected, but again, the appreciation of data is definitely an investing superpower, and we're going to get into that a little bit.
Well, yeah, I mean, you can hit on that quickly, Justin. I mean, that's the number one sales tool for most of Goldman and Morgan brokers out there. I can get you this hot IPO and get you an allocation, right? So they just ignore the data.
Yeah, exactly. Hey, again, the bright, shiny object, Last item on the news front, Twitter founder and CEO Jack Dorsey, been at the helm for quite some time, is stepping down. So not sure exactly what his plans are. Probably,
just run his other company.
Run his other company Square and booster crypto and blockchain, or we'll see. Anyway, so those are some relevant news topics as we turn the calendar to December here, and I think this is an interesting topic that, like I said, touches on some of these headlines that we've just highlighted, and really important as we enter the end of the year here.
Yeah, no, I think it's a great point, Justin. And I think getting into these superpowers, you already hit on one of them, right? It's being data driven and actually paying attention to the data and making decisions based upon that. And really what that ultimately culminates with, I think at a very high level, is actually having a plan for what you're doing. We call it an investment philosophy in our world, but really just having a good set of principles that you're going to make decisions on. And, one place I'd love to start is really that long-term focus, because I think it gets talked about a lot, be a long-term investor, blah, 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 blah. And I think it gets thrown around a lot, but people don't really understand it, right? It's, because we're emotional, because we still get, impacted by Friday's pullback. There's another COVID variant that might shut down the world. I get nervous. I see markets fall. All of that's super normal. But then we're sitting there going, don't worry, it's about the long term. It's about the long term. It's sometimes hard to reconcile those two. And I would love to just hear you hit on a little bit, when we're talking about long term, it's, how are we thinking about framing that. Is long-term 5 years? Is it 10 years? Is it 20? Is it different for every person? Or, we know the short term, right? I made the joke with you earlier. We know the fat guy that's just trying to like stop heart disease at 65 years old. He's looking for the next weight loss pill. Bad decision. But most of us, are out there without a good sense of a real long-term plan. We're looking for that weight loss pill and we're trying to catch a market here or there. So maybe frame for us what long-term actually means in our view.
Yeah, and I mean, we were saying it before while we were prepping. Our tagline, our intro should be, or we should add it, to invest like a pro. It's invest like a pro for the long term, and it's hard because our brains aren't wired for this. But to answer your question or your point directly, I mean, the long term in general in our world is multi-generational. But that being said, there's a definition that is unique and specific to each and every client. And that gets back to custom portfolio management with your priorities in mind and not just trying to chase a return or fill out a questionnaire that says, okay, yeah, you're 30 years old, you have a risk tolerance score of X, you go into an 80-20 portfolio. It's taking all of that a layer and a level deeper to really to figure out your priorities, put them into a well thought through structure, financial structure, with the appropriate data inputs to support it. And that gives you a portfolio that is built for the long term. So that could be a portfolio that's built for 20, 30 years. In general, that's probably where I would put the cap on the downside of the long term. But we're talking for over very long periods of time. And especially in this day and age, it's so difficult to appreciate what that truly means. My wife is actually giving me a kind of a hard time. She's like, you guys, you talk about long term a lot. And it's so true because that is incredibly important. However, it's hard to always reframe your mind, your thoughts, the day-to-day chatter, the new investment opportunity with the long-term focus in mind. So it's something we'll continue to talk about a ton because it is incredibly difficult to appreciate.
Well, and I love what you hit on there and I was hoping that's where you were going to go, is the long term really matters on your personal situation. And so, it does go back to what long term affords us is the ability to go through Friday, right? And not worry about it and allow our assets to grow over time. And so there is a portion of your portfolio that's, you want to grow over the long term. You want to be rewarded. You want to take those rides. If you're not taking those rides, you're not maximizing what the ability is of that allocation of assets. Yet, you don't want to take that ride with everything. Somebody sent me a post from Dave Ramsey over the weekend, and it's like, put all your money in 100% in equities, don't ever invest in bonds. It's like, that's the most idiotic thing I've ever heard. You know nothing about somebody's situation. It's like, well, yeah, if you saw a bunch of media sites and newsletters, Dave, and you're making money off others, like, sure, maybe his allocation should be 100% equities. But for most of us, right, it's actually the opposite. We need to figure out what our priorities are in the short term so that we invest in the proper way for those priorities, and then take the longer term kind of approach with the assets that we're willing to ride the ride with and essentially grow over time. And if we're fortunate enough to have multi-generational wealth, which most of the people listening to this do, it's maximizing that, the priorities, making sure you achieve all those essential and important priorities for yourself. But then it's looking at the places where you really truly can outperform the private markets, like we often talk about, that take your time frame out even beyond that 20 or 30 years that you talked about, Justin. I mean, this is 2, 3, 4, 5 generations down the line. So it really is, the superpower is, certainly long-term focus, but more so understanding what is long-term for you in the context of your overall customized individual investment philosophy.
Yeah. Well, and even putting kind of maybe more of a bow on it too. Time is the superpower, right? The ability and length of time that we have, and people that are listening to this are hopefully engaged in and listening to this because they want to think through this, they want to plan, they want to get ahead. Right, the time to look for a weight loss pill, or what, I can't remember the example you were highlighting. The time to figure out your diet is not when you're 65, 70, 80 years old. It's like you should have figured out your diet when you were 30, right? Get ahead of it. So time, it's the same type of mindset. Don't plan when your goal is tomorrow, or when your goal is next year. Plan when your goal is 30 years away, so you can benefit from that element of time, that superpower of time when it comes to investing. Switching topics a little bit, because I think, or not topics, switching superpowers, if you will, because I think it's relevant to what we've touched on now, is also not having this fear of missing out, right? Because the FOMO, as we call it now, it relates to time, and all of these things do relate to each other. And really, at the end of the day, it all relates to having a philosophy, which I think we'll probably conclude with, is not introducing frictions to the portfolio and chasing a fad that, hey, Bitcoin is now at $60,000 per coin. I'm going to put my money into that now. Chances are that that's somewhere near the top, or who knows? I'm not trying to predict the future, but time and time again, if you go back to the data and you look at how money moves in and out of whatever asset that has positive momentum or positive performance over the recent period of time, money moves into it at the absolute wrong time or near the top, and then it comes down and money moves out of it. And so it's just this constant kind of chasing the tail type thing, keeping up with the Joneses, whatever phrase you want to come up with. We all know one phrase that kind of speaks to this fear of missing out concept. And really, at the end of the day, it's taking a step back, looking at market data over long periods of time, understanding that you have an incredibly long period of time to invest and have an expected rate of return, positive rate of return that will benefit you, and your portfolio is geared towards meeting your priorities, should help you understand and put kind of those fads into a better concept or context. Now, again, all of this is incredibly difficult, but this is why we're doing this podcast.
Yeah, I think it's a great point. And to kind of sum it up, I mean, it sounds like, and I very much believe this is right. It's framing what are your, going back to the priorities. And I know we hit on this a lot, but what's the impact to your priorities? I got another text from a client this weekend. What do you think about some of these NFL guys taking all their salary in Bitcoin? And it's like, well, I'll go on record. I think it's dumb. It doesn't make any sense. However, what we also don't know is the background. Like, they're being endorsed by these companies, how much of that is being mitigated, the potential downfall, et cetera. But I bring it up because it really goes back to what's the impact on your priorities. If it has an outsized impact, if things go wrong, if you're homeless, if things go wrong, if Bitcoin goes to zero for some reason tomorrow and all of your wealth is tied up in Bitcoin, or if Apple turns into the next Enron somehow and there's a bunch of financial engineering and the company blows up, but you've got all your wealth in Apple, same difference there. You're basically putting your entire financial structure in the hands of a very small, a very small probability of happening, but catastrophic if it does happen. On the flip side, it's kind of going back to this diversification with Friday's pullback. There's a lot of advisors out there talking about diversification and this being a benefit. We got reminded why people have bonds in their portfolio on Friday. We're taking it a step further and saying that, just simple diversification doesn't even really get you all the way there. It's tying it back to your priorities to say, what are the range of outcomes and how big of an impact does that actually have on my life, my priorities, et cetera. That's the real superpower, because understanding those impacts allows you to maximize on both sides. Maybe it's you live such a simple life. We all know the story of the hypothetical janitor in Indiana that saved every dollar he had. He passed away and gave $10 million back to charity. And the reason he was able to do that, right, is he lived a very simple life and saved everything and compounded it very simply over time versus, the person, the CEO that makes millions of dollars a year flying around on his private jets and, the dude's homeless at some point. So it really just comes back to framing those priorities and the impact that your decision making could have on
Right.
those priorities.
Totally. And I'm going to go back to what we call a philosophy. What you're hitting on is building a portfolio around priorities, and give us feedback on this, because this is, I think, really truly the goal of this podcast is to help understand or move the understanding away from the speculative part of the markets, if you will, which is generally what you see in the headlines, to what, at least the way we think about it, to the long-term investing side of the market. And it relates to the priorities that you have, the unique priorities you have, and how we then take those and build a portfolio to support them. It's way different than, okay, what's the next Tesla? I'm not, there's no way. And anyone who tells you that they can pick the next Tesla is, full of absolute BS, but that's another conversation. But what really is important, again, hopefully we're slowly advancing the ball down the field in this endeavor, where what matters is your unique priorities. We're working through a case right now where it's actually kind of exactly what you just hit on. This individual has two positions that make up roughly a third of his net worth, and they are incredibly highly appreciated, so sitting on a big capital gain. But the way the estate plan has to be structured is it potentially puts this individual's priorities at risk holding on, or it does put his priorities at risk holding on to these two positions. They've done incredibly well. He's been very, very lucky and benefited from maybe he was right and picked the right stock, or maybe he was lucky. It doesn't really matter. He's benefited from it. He's sitting on this appreciated asset. But in order for him and his family to reach those priorities, those assets need to be invested in a different way than, I would argue, what was more of a speculative type decision he made early on. Again, worked out in his benefit, but it needs to be invested in a different way for the long term to now support his priority. Holding on to these two stocks that, if they went down 20%, 30% tomorrow, which is a very, very real probability, or real possibility rather, would put him and his family at risk. And that's kind of really where the rubber meets the road here. It's a tangible example of investing for the long term to support your priorities, instead of just chasing fads or chasing hot topics, if you will.
I think it's a great place to kind of sum it all up, Justin. And, going back to Friday, market pullback day after Thanksgiving, new COVID variant, likely the cause for the angst in the markets, which is a healthy thing, right? New information presented, the markets adjust. That's how it should work. Excuse me. But it's a good reminder, right, of going back to the ultimate superpower. The ultimate superpower is having a plan, having what we call an investment philosophy that identifies all these different areas for you individually to customize that portfolio. What is your time frame? What are your priorities? How do we actually implement here so that we go through a market disruption like we did on Friday? You rest easy, you have your leftover turkey, you watch some more football, and you don't worry about it, because at the end of the day, you have a portfolio that is built for you. It's built for your priorities and really to maximize your wealth. So with that, we want to thank you again for tuning in. We encourage you to head over to awminsights.com. We've got some resources there that you can download. We'd love to hear from you. Give us feedback. We're obviously headed into the end of the year. We would love to know what you'd like us to focus on in the new year. We've got some big plans for the podcast, but we'd love your feedback. So, but until next time, own your wealth, make an impact, and always invest like a pro.
The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.